Today, I witnessed what I'm going to call is a very unfair result of the tax code. Picture this: you're married, filing jointly, and you have two children. And let's say you make somewhere between about $35,000 and $45,000. You're going to get a very large earned income credit. I'm talking 2,500, $3,000 per kid. So that means if you had zero taxes withheld just from an earned income credit, you're going to get back like $5,000, $6,000. That sounds crazy, right? Just in and of itself, that's how the earned income credit works. Now, one of the stipulations for the earned income credit is that you cannot have investment income of more than $10,000. Now, on first sniff, that kind of makes sense. All right, somebody's getting $10,001 in dividends. He probably shouldn't get the earned income credit because that means he's got a portfolio with a whole lot of money in it, and that's not who we want to give an earned income credit for. Okay, that makes sense. Well, what about this? Right, this happened. I had a client married, filing jointly between him and his spouse. They were making about $40,000, but one of them also was renting out a property that they did not own. So a family member came to them and said, "Hey, put this on Airbnb. You pay me some small fee and you get to keep the profit." So he did that, and he had about $11,000 in profit, right? So his expenses are paying rent to the actual owner of the property and covering utilities and maybe some other expenses there. And then the profit he got from re renting that on Airbnb was about $11,000, right? When they came to me and they said, "Hey, what else can I do differently?" And I asked them about a couple of different expenses on that rental income. I said, "Well, did you drive to the property? Because I didn't see any mileage there." They said, "Oh, yeah, we did a lot of driving." So we input what turned out to be about $1,500 of standard mileage deduction, which dropped our income from this rental property from $11,000 to $9,500. And you know what that did? All of a sudden, they fell under the $10,000 cliff for earned income credit investment income. And when you fall under that cliff, all of a sudden, the refund shot up $6,000 because of the earned income credit. Is that not completely insane? So, for instance, he could have had $10,001 of investment income, and he would have not been able to receive a $6,000 earned income credit. The cliff, in this sense, makes zero sense. Have there be some sort of phase out, like the many other sections of the tax code that allow some sort of slow phase out. But here you fall off the cliff and you get nothing if you have more than $10,000 of investment income. Crazy. Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.